What's up, guys? It's Ryan. Thanks for tuning into the channel. Today, what we're going to be talking about is the infinite banking concept and how you can leverage life insurance to your advantage. And that I'm going to teach you guys in this video how to use life insurance the same exact way that banks and millionaires and billionaires use life insurance. So, I'm sure that every Friday you guys get paid and put your money in the bank, right? But what you don't realize is that there's something called fractional reserve banking. And so banks only have to keep 10% of the money that you deposit into the bank actually in the bank. What they do is they go take the other 90% and they go put it into BOLI, which is bank owned life insurance. And right away I'm sure you guys are just like, what? Life insurance? Why would banks put money in life insurance? Well, I'm about to tell you why. It's because they get an average of 10% interest on your money, on 90% of your money, and they can access that money whenever they want. The money is liquid. So what they do with it then is they take it out of the BOLI and they lend it out to you for a car loan or a mortgage or credit cards, personal loans, business loans, and college loans. And they're making a spread on your money. So this is your money over here, and now the banks are making trillions and trillions of dollars off of your money. We don't want you to do that anymore. We don't want your money to make the bank's money. We want your money to work for you and make you money. So we're going to cut out the banks. We're going to cut out the middleman, because that's all the bank is the middleman. And now when you get paid, you're going to put your money into an IUL, your own personalized bank, your own life insurance policy. It is a life insurance policy, but it acts as like a savings account, and I'm about to show you how. So you put your money into an IUL, indexed universal life, and you are going to be the person who's going to get that average 10% interest on your money. And on top of that, look at this. In the bank, the interest that you collect from a regular bank account is anywhere from 0.01% to 0.06%. You're not even collecting 1% interest on your money. That's ridiculous. If you put your money in a high yield savings account, you're going to get anywhere from 3 to 4% depending on which high yield savings account you use. If you have your money sitting in a 401k like most Americans, or a Roth IRA, probably other Americans, then you'll be getting anywhere from around 6 to 7%. These are all averages, but it does hover around that area. And then if you put your money into an IUL, you're going to get an average of 10% interest. But here's the thing with the 401k and the Roth IRA is that your money is literally locked up in money jail, and you're not supposed to touch it, or you're not really allowed to touch it until you're 59 and a half or retired, whichever comes first for you. Then on top of that, you have to pay federal tax, state tax, and IRS penalties. The IRS penalties is only if you touch the money before you're 59 and a half. And on top of that, also, you get taxed with the 401k. You get taxed as earned income, even though the money that's in your 401k is in the stock market. For some reason, you get taxed at earned income instead of capital gains tax. So what that does is that if you ever take money out of your 401k, it's going to count as earned income. And 9 times out of 10, that's going to put you up at a higher tax bracket. And it's going to completely screw you when you're doing your taxes, like especially when it comes to tax time. You're going to owe so much in taxes because the money in your 401k counts as earned income instead of capital gains tax. So anyways, the reason why you'd want an IUL is because it's liquid, again, and there's a floor rate. So what that means is that you have market protection and there's predictability with your money in the market. So what the floor rate basically means is that the stock market crashes and everyone loses money. Like everyone's in the negatives, like -30s, -40s. Think back to the 01.com crash and the 08 housing market crash. Everyone was in the negatives. Not you if you had an IUL though. Depending on the carrier, the floor varies between 0%, so you can break even at 0, or 0.75%. So what that means is that like the lowest amount of interest you can collect on an IUL is that 0.75% or the 0%. Also, they're tax-free. So like how I just mentioned, if you take money out of the stock market, you're going to pay capital gains tax. If you take money out of your 401k, you're going to pay federal and state tax, and et cetera, et cetera. but not in an IUL. You will never pay taxes on your money in an IUL if I structure it for you. Because the way I structure your policy is, oh no! All right, ignore that. The wind just blew this on the floor. But anyways, I structure a policy for you. I'm gonna structure it no MEC, which just means that you won't ever pay taxes on the money that you put into an IUL. And that's the premium and the interest. It's both, not just the premium. A lot of people ask me that, like, oh yeah, I'm sure it's tax free only on the premium. No, it's tax free on the premium and the interest you collect on your premium. Also, I think I already talked about like the liquidity side. Again, you can access the money in here just as easy and actually easier than your money in your bank. All you have to do is just call the insurance carrier or call me, and we just initiate a wire transfer, and boom, the money's there. It's that easy. You don't have to go to the bank and do it. Also, dual action. So at the end of the day, it is life insurance. So there's only two requirements from you. One, you can't have a felony. You can't be a convicted felon. And two, you just have to be healthy. And even if you are moderately healthy, like if you have high blood pressure or if you have had a heart attack or if you recovered from cancer, you still can get one, but it's just going to be a little bit tougher. I'm just kind of just going to have to like fight harder for the insurance carrier to accept you. But if you are moderately healthy or healthy, then you should definitely be able to qualify for an IUL. If you're very unhealthy, like if you have diabetes and you've had 2 heart attacks and you have cancer, yeah, you're not going to qualify for an IUL. And the reason why I say it's dual action is because, like I had mentioned, it is life insurance. So you get a death benefit side as well as that cash value accumulation side. So it is dual action in that sense. Also, you get the uninterrupted compound interest. So basically what that means is that you can pull the money out of your IUL, use it in real estate. So let's just say you have $10,000 in cash in your IUL. You borrow the money out at 2%. So now this $10,000 is going to grow at 8%. Oh, that is such an ugly 8. Sorry, guys. At 8% instead of the 10%. But you use this $10,000, let's say, as like a down payment, or you wanted to like renovate, the kitchen or something, and this duplex you just bought as your real estate investment. So you just took the $10,000 out of your IOL. You borrowed it at 2%. So now you're making a net 8% interest, even though you're using the money somewhere else, you're now using it in this real estate deal. So now you're getting 25% ROI from this duplex, let's just say, for the sake of this video. And now you can add an additional 8% to the end of that and have a net of 33% just because you funneled your money into life insurance before you put your money into this real estate deal. Same thing goes for a car. If you buy a car, you can actually, like people say the worst investment you can do in life is buy a car. Yes, I 100% agree with that because of the depreciation value and everything like that. If you don't want it to be that bad, pull money out of your IUL to buy the car so that you are still accruing interest on money that you use as a down payment for a car. See how it's already like helping you out in so many different ways. And also, like I just mentioned, when you borrow the money, it's not like a traditional 401k where if you borrow the money, you have to pay it back. In this case, you can borrow the money and you actually don't have to pay it back, which is really, really nice and beneficial for you. So if you guys like the content in this video, make sure to subscribe. Make sure to share with a friend or somebody who you think would benefit from knowing this. And make sure to give this video a thumbs up. It helps YouTube push my videos out to more people. And let's become financially free together.